If you're trying to, look at the futures and trying to, get in right in the morning and think it's going to go up, you're probably already too late. This is Michael. I enjoy your presentations and you keep me informed and laughing. I drive a Toyota Sienna minivan and drink most anything. Love this guy.
That sounds like you.
Yeah. I was going to say a man after Joe's heart.
Could you answer the following? Okay. How are stock futures determined? Other than the market open, futures seem to have no relevance to stock prices later in the day. Who determines futures? Oh boy. Did you get your CFA hat on there, Big Al?
CFA, yeah, we got Robert Nowak and Brian Perry of Pure Financial that helped us out on this, Joe, because the answer is we don't know.
Yeah, derivatives. It's a very complex security.
It is.
And it's, it follows closely because it's overnight trading, right?
Yeah.
So you're not buying the actual index. You're not buying the stock. You're buying the derivative of the S&P 500, let's say.
Yeah. So, right. So, yeah, S&P 500 future is follows the index. And it basically, I think people watch it when the market closes to open to try to figure out where it's going.
Right.
Right.
But it has very little relevance.
Relevance?
Relevance.
It's got a little relevance too.
It's got some relevance. Very little relevance later in the day. So you look at what people are doing overnight and what are they buying and things like that. So it's kind of a trending mechanism, probably for the open, so it's tied somewhat closely. But yeah, if you're trying to, look at the futures and trying to, get in right in the morning and think it's going to go up, you're probably already too late.
Probably. Yeah. And I'll read the first couple sentences of what Robert and Brian Perry wrote. They said they're derivative securities, which means they derive their value from another asset. So, for example, S&P 500 futures derive their value from the S&P 500 index. They both move hand in hand. So if the S&P index closes up 2%, the futures will also close up around 2%, not exactly, but around 2%. But the futures also trade after the stock market closes. So overnight and before the market opens, the futures give a good indication where the actual cash index will open, which is basically the link between the futures and the market, right? So I think that's a good enough summary, right?
Yeah, I think so. He's got another question here. He goes, why does a company care about the stock price? Haven't they already sold the share? Other than employee compensation being tied to the stock price, what is the relevance? Let's see, he likes it.
Well done.
To the company. I must be missing something, but it seems similar to me selling my car and then worrying about the value. I appreciate your show. Thank you. Well, a couple of things in regards to the stock price. A lot of companies hold their own stock on their balance sheet. There's a lot of stock buybacks that you might have heard of in recent years. But I think he hit the nail on the head, is that a lot of executives are compensated via the stock. There's, restricted stock, there's stock option plans. There's all sorts of different things that people or companies want to get their employees involved a little bit more in the overall success of the organization.
Sure.
And so they reward them with stock. And if the stock price goes up, well, their compensation will go up in regards to whatever executive type compensation plan that they have.
Yeah, exactly right. And many companies have plans for all employees, right? So all the employees have restricted stock units, or at least the key ones, or stock options. So the employees have a vested interest in having this thing grow. Now, of course, the other part of this is it's kind of a scorecard, right? Especially if you're an executive.
Oh, for sure. If you're the CEO of the company and the
stock market dives,
you're fired.
Yeah, how are you going to get another job, right?
You're done.
Let's see what you did for this company. Forget it.
Right. But that's a really good point, because, once a company goes IPO, it's like they raise the capital and then now the stock is on the market and other people hold that stock. And so but even though companies still own their own stock, but the majority of the stock is already distributed out of the company.
Right.
So it's a really good question. It's like, well, why the hell would he care?
Right.
Well, there's many reasons why they care.
Yeah, but it is a good point. As you say, IPO, what's that? It's
initial public offering.
Thank you. Okay. Slipped my mind for a second. So in other words, a company does an IPO
because they want cash.
They want cash, right? So a whole bunch of people buy shares in their company and the money comes into the company, right? And the company uses that money to generally to hire new people or R&D or something like that to build for the future. That's usually what it's for. And in some cases, some of the key people take liquidity. They take some shares off the table. So that's part of it too. But so typically, once the money comes into the company, it's all done, right? And so now one person A is selling to person B that has nothing to do with the company. So the question is, why should the company care? And the reason is because of compensation issues for key employees and sometimes all employees.
Right. Well, you look at Bezos. You don't think he owns a little bit of Amazon?
Yeah. And do you think he cares?
I think he cares.
So.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.